and thank you, ICICI Institute of Insolvency Professionals, for having us here to share our perspective on turnaround of a power company. And Ravin will then speak about, he'll share his legal perspective on the CIRP of power companies. So with this, we can start the session. So this is the workshop outline. The first half would be we'll be speaking on an overview of the power sector. Then we'll briefly touch upon the power sector under IBC, how the CIRP or liquidation of power companies has fared so far. And then we touch upon or we'll go into details of a case study of a power company, a thermal power company, which was making losses and how the operations of that company were turned around during the CIRP period. So just to give you a brief perspective on the power sector and why it is so important as a sector. India is the third largest producer of electricity globally after China and USA, with an installed capacity of about 430 gigawatt. Our per capita consumption currently stands at about 1300 kilowatt hour, which is also called the unit, as we know in the common parlance. This has doubled in the last 15 years. And but however, it continues to be low as compared to the global average, which is around 3600 units per person. Electricity generation has grown at a rapid pace in the last 2-3 years. However, if we look at the data for the last 15 years, the CAGR growth has only been about 4.8%. However, over the next 5 years, 10 years, in line with the economic growth and the electrification which is happening in the country, where every household would be connected to the grid, this number would shoot up massively. In terms of capacity, thermal power continues to be the mainstay of power generation in our country. It contributes to about 75% of the generation, though in terms of the capacity, it stands at about 57% thermal power generation, and that can be broken down into coal-based and gas-based. Coal-based capacities contribute to about 51% and 6% is contributed by gas-based facilities. And then the balance 43% comprising of hydro, wind, solar, and nuclear add up to 43%. However, among this 43%, hydro and wind and solar, they are major contributors. In terms of the split between the ownership, the private sector contributes to about 50% of the installed capacity. State contributes to about 25%, and 25% is by the central sector. So since 2003, when the Electricity Act was enacted, and that consolidated the major acts which were prevailing then, there has been a tremendous growth in the power sector with lot of capacity additions happening. And the government of India over the last of several years has taken several initiatives to further the growth of this sector. As most of you would be aware, this sector comprises of three parts. You can say you can divide it into generation, transmission, and distribution. So all these legs are being given an impetus by the policies. Certain policies like Uday, IPDS, NSGM, Shakti scheme, they have been undertaken to improve the financial health of the discoms, which are the major consumers, and the health of the generating companies. It goes without saying that the health of the generating companies would continue to be dependent upon the health of the discoms, because if the payments are stuck with the discoms for a very long time, then the health of the generating companies gets affected. And many of the companies, this has been a major reason for the stress. What the government has done is they have stated that if the dues are not cleared within a particular period of time, that is after the due date and after giving some grace period of 45 days, then the discoms will not be able to buy power from the exchanges. And this has worked well. And they have cleared dues of about 1.3 to 1.4 lakh crores to the generation companies. Increased electrifications, rooftops, solar schemes I mentioned that these have helped in generating more demand, and renewable energy continues now is the focus. Given the commitment of India in the earlier COPs and the recent COP 28, which was held in Dubai last year. So as I mentioned, while over the last 15-year period, if you see the electricity consumption has gone up by Deshabak, has gone up by only 4.8%. However, last year the electricity growth was around 10%. And in terms of investment, it is as per the National Electricity Plan, investment of around $400 billion, a huge number, would be required over the next 8, 9 years to meet the rising energy needs. So a lot of investments will go into both fossil fuel and non-fossil fuel plants. These things I mentioned that the factors which are leading to increased demand are increased industrial activity and growing population and electrification, which is happening. So the next Electricity Act, the, the Electricity Act 2003 brought in massive changes as compared to the earlier regulations. It is a comprehensive legislation which legislates the power distribution, generation, and transmission. As you would be aware, electricity is a concurrent subject in the constitution. Hence, it can be legislated by both the parliament as well as the state legislature. However, distribution continues to be a state subject. What Electricity Act 2003 assured in is a license-free regime, and it increased the competition among the players, allowed entry of private players. That has resulted in an increased supply, increased capacity addition. And India is now, as I mentioned, is the third largest producer and consumer of electricity. See, while this sector continues to be one of the key sectors which drives the economy, uh, from an environment perspective, it is very essential that there will be sustainability in the sector, and that can be brought in by weaning away or from the fossil fuels and concentrating on the renewable energy. This sector contributes to about 25%, that is the estimate of the total global greenhouse gas emissions. Hence, countries together earlier through the Paris Accord and through the climate accords, they have been pushing for reduction in the greenhouse gas emissions. COP 28, which was held last year, they have approved transitioning away from fossil fuels. A roadmap has been laid down. However, India, given its economic and development needs, they have stated that they do not intend to walk away from the coal generated power in the near future, at least for the next 30, 40 years. While India has committed to being a net zero, having a net zero position by 2070, however, capacity additions in the thermal power sector will continue to happen because coal continues to remain in abundance in our country, and coal generated power is a reliable source of power. Just to touch upon some common terminologies which are used in the thermal power sector. One is what we call the kilowatt hour or the unit. which is the measurement of electricity consumptions. The electricity bill that we get in our households is who has this units. PPA is the power purchase agreement. It's an agreement between the seller and the buyer. So between the electricity generating company and the buyer, in the most cases, these are the discoms. Plant load factor is the percentage utilization of the plant. So let's say 60% PLF means that 60% utilization of the plant. FSA is on the supply side, fuel supply agreement, as we call it. It's a contract for supply of fuel to a power plant, mainly by the Coal India and its subsidiaries. So wherever I have a long-term PPA, ideally I should have an FSA in place, because if I have to supply for 15 years or 20 years or 10 years, I need visibility in terms of getting my linkages in place. Pithead power plants are the plants which are located close to the commercial coal mines. They have the advantage of having lower costs because the source of coal is located close by, and there would be lesser transportation costs. So the cost of coal overall would be low. Also, shorter distances means that lesser leakages. Capacity is what we define as the continuous load carrying ability of the power plant, which is generally expressed in megawatts. When we say 300 megawatt plant, 600 megawatt, or a 1200 megawatt plant, this is the rated capacity. Ultra mega power plants are the focus. They are plants which have more than 4,000 megawatt or more of capacity. uh, the efficiency of these plants is very high, and hence these plants are required, and the focus of the government is on setting up of more of these power plants. Now coming to we talked about the power sector. Now coming to the thermal sector. The thermal power sector contributes to 57% of the total capacity. However, given that it has a higher ELF, it contributes to 75% of the overall generation in our country. Coal-based capacity is around 208 gigawatt in January 2024. That is expected to almost double by 2040. As I mentioned, that India would continue to add more coal capacities given the growth that it is seeing. And the economic growth has to be supported by a reliable source of power, which remains coal. I've just mentioned the cost. How much does it cost to set up a power plant? Earlier estimates were 5 crores per megawatt, 6 crores per megawatt. These costs have gone up. And as per a recent report by the Ministry of Power, when I say recent, about a year old, they have said that a new coal-based plant will cost about 8.34 crores per megawatt. So if I have to set up 1,000 megawatt power plant, it would cost me some 8,300 crores. And setting up of power plants has a long gestation period. I mentioned that coal-fired power plants, they provide a reliable source of power, reliable and constant source of power. Unlike in case of wind, solar, and hydro, which is available at certain times or certain days in a year, a coal-based plant can be run continuously, and hence the PLF would be very high. And now coming to why are we dependent on coal-based thermal power plants? One of the reasons is that India has abundant coal reserves. India ranks fifth in the world in terms of coal reserves, and in terms of coal production and consumption, India ranks second in the world. We produced about billion tons of coal in the last year, which was a 12% increase compared to the earlier year. And for the current year, it is expected that 10% the increase would be there, and hence we would do about 1.1 billion tons of coal. The target of the government in the next few years is to reduce the dependency upon imported coal. Hence, Coal India is working aggressively towards boosting its output and meeting that target. Now, coming to major reasons for the stress in case of power plant. So we have seen that many thermal power plants, hydro power plants, they were under stress. Many of them have been resolved under IBC. There are a few cases still under IBC which are getting resolved. Like any other capital intensive project, this setting up of a power plant has a long gestation period. And but typically, because of the delays in getting approvals, getting land clearances, financial closure, the cost overrun would be there. That makes the project unviable. A lot of capacity addition which happened in our country earlier, that happened without corresponding tie-up of PPA with the discoms. So on one hand, I have spare capacity. However, there were no takers for that capacity. Also, there was a mass cancellation of the coal blocks due to a Supreme Court verdict a few years back. Some 200 plus coal blocks were cancelled, which led to a situation where the power producing companies which are tied up with these for fuel with these coal blocks, they were stranded because they did not have a fuel arrangement. As I mentioned, the last few years, the last 15 years number, if you see, there's only been a growth of about 4.8%. However, the capacity additions after the Electricity Act of 2003 were massive. So there was a demand and supply mismatch. Also, for thermal power plants, while coal is available in abundance, there were two challenges. For gas-based plants, which were dependent upon natural gas, the plants were set up with the thinking that you would get fuel from the KG basin. However, given the low output, the domestically produced fuel is not available, and hence to rely upon imported fuel is not becoming very viable to operate a gas-based plant. For thermal plants, after COVID, because of the Ukraine war, which happened, and other geopolitical factors, the prices of imported coals went up by two times, three times, four times, and that made them that made them unviable for a long period of time. So this table, I have put some of the cases, some of the major cases which have been resolved uh, under IBC. If you see the average recovery so far has been in the range of 1.75 crores to 2 crores a megawatt. However, in the current market scenario where the demand is booming, the existing cases which are yet to be resolved, they are seeing an increased realization for the financial creditors. Also, some of these cases, there were plants which were not fully complete. So, so to say that the realization was very low may not be very correct because they were not operational plants or not complete plants. About 20% recovery has been seen for the power cases so far, and about little over 2.5 years of for the resolution time. I have highlighted one interesting case of Jabua Power, which was taken over by NTPC. In this case, the lenders also, as a part of the resolution, they also got a 50% equity. And that has helped them, the rich dividends which are being paid out by NTPC, as was reported in the news, that has helped the lenders recover a large part of their recoveries. So this could be a viable model where lenders take an upside into the equity. They take some equity and hence they share the upside. If we also, just to highlight the recent, if you see the 2023 cases which are there, they have shown higher recoveries as compared to the earlier years because of the changing demand scenario and the industry scenario. These are some of the major cases which are undergoing a resolution in the CRP. KSK Mahanadi about 1800 megawatts, Inner Thermal 1350, Coastal Energen 1200, Lanco Amarkantak 600, SKS Power 600. For Coastal, Lanco, and SKS, the resolution plan has been approved by the COC. KSK Mahanadi was reported recently that fresh bids have been invited to start the process on a standalone basis. And Sinnar Thermal is has the process has started. So these cases, it is expected that there would be a good recovery for the lenders, much higher than what was there in the for the earlier cases. One of the additional reasons for this is that many of these are operating companies, and operating companies are generating cash, and the RFRP normally stipulates that the cash which is there in the company as on the transfer date will go to the financial creditors, and that is increasing the recovery for the lenders. Now, having touched upon the power sector, the thermal power sector overview of that, and how the resolution has happened under IBC for the thermal power cases, let us come to the a case study of the turnaround of a power company. So this is a turnaround framework given by Slater, Lovett, and Barlow in 2006 in their book. These are the 7 points which they say are very critical when you want to turn around a company. So one is a crisis stabilization, new leadership, stakeholder management, strategic focus, critical process improvement, organizational change, financial restructuring. We would, in the coming slides, we would see that all these points have been covered, and only when you address most of these points, you will be able to see a financial turnaround. So about this company, it's a thermal power company with a 600 megawatt capacity, with a debt size of 2,500 crores. It was earlier envisaged that 1,200 megawatts would be constructed in 2 phases. Phase one comprising of 600 megawatt, phase two comprising of 600 megawatt, and each of these phases would consist of 2 units of 300 megawatt each. Phase one has been constructed, phase two has not yet been constructed. The common facilities have been constructed for both the phases. The reasons of default are the same as I had mentioned for, which are common for most of the thermal power companies, which is the lack of PPA, lack of FSA, and cost overruns, the health of the time that puts in stress on your balance sheet also. The CRP commenced in April 2022. So it's been a little over 2 years now. So when we took over this plant, the operations were shut. They were shut for the last 6-8 months because there was no maintenance and the company was short of working capital. Because the company was an NPA, but there was a cutback, and banks used to cut back a significant portion, about 15-20% of the overall receipts. And because the margins were not so much, as time progressed, there was an increased, because of these cutbacks, there was an increased pressure on the working capital. The creditors were mounting, inventories were at a depleted level, and hence plant was shut. One of the key reasons for the stress, as I had mentioned in this company, was that it did not have significant PPAs. And whatever PPAs were there, they were not profitable because of an interim order of the Supreme Court. The company was forced to sell power at a rate which was nowhere close to the market rate. And on top of that, it did not have linkage coal. So it was a long-term PPA, and the company did not have linkage coal, which meant that it had to buy coal in the auction in the market, and which was pushing up the cost of generation. Every unit that the company was selling, it was incurring losses. But because there was a Supreme Court order, then nobody wanted to kind of pull the plug and stop the unit, because that would have meant that you are not obeying the Supreme Court order. So this was one of the major drains into the profits. Also, there were several unresolved disputes with the discoms. One of the major factors for the generating companies going down under is because of the financial health of the discoms. Typically, when the discoms do not have money, they would resort to uh, calling out some lapses in the supply of power, and that would result in disputes. So this company had supplied power, but there were a lot of backlog of receivables with several discoms. There were huge penalties, which this was a cycle where, because of the huge receivables, you were not able to supply power, and because you were not able to supply power, huge penalties would be levied. Because as per the PPA, you need to supply power, keep your unit available, and supply power for 85% of the contract value. So on one hand, you did not have enough PPAs, you did not have FSAs, which is linkage coal, which you need. Also added to that, you had an onerous contract with a trading company. So yeah, where this power producing company had given exclusive rights to this trading company, saying that we will do all short-term, long-term, and medium-term PPAs through you only. And this trading company, because of the credibility of the power company, the units were not being operated on a regular basis. They were not tying up power. So it was very essential for the company to walk out of this onerous contract so that they could enter into contracts with other trading companies, or through or directly with other discoms. Typically, when the company is under stress, you would see that key employees would leave the company. That remains a major challenge for managing any stress company. In this case, there was no involvement of the promoters or board of directors for the last couple of years before CIRP, and hence there was a management vacuum. So the head of the commercial operations, the senior most employee who was taking care of the company, and there was a mass exodus of key employees. Because of this and lack of working capital, where your dues used to pile up, there were frequent issues with the suppliers. There were interdepartmental conflicts, and hence the morale of the employees was very low. Another major issue which we faced was that the financials of the last 4 years were not finalized due to some management differences. And but that was a key task which was thrust upon us to complete as a resolution professional. So these were some of the key issues which we faced. And how did we go about turning around the unit? What were the key steps that we took? So first of all, before we start any unit or because there was a lack of working capital, there was a clear need for interim finance. And so we worked out an interim finance requirement of about 100 plus crores to start the unit and operate it. And this was an initial requirement. It was a Herculean effort to get the interim finance. However, after a lot of discussions, the committee of creditors was very supportive in our case, and they granted an interim finance of 100 plus crores. This would be used towards the essential maintenance of the plant, to pay off the salaries of employees, and for buying coal and the required fuel. So basically for working capital purposes. So we raised the interim finance, operated the unit, started the unit in about 3 months from the insolvency commencement date. However, there was a very strong monitoring of the cash flows and the expenditure that we were incurring. The unit was running into losses for the first 6 months of the operations. However, one may argue that going concern is an underlying principle uh, which should apply for companies under CIRP, and you shouldn't run the unit at a loss. However, we could foresee that once we cross a minimum threshold, we would start generating profits, and the lenders reposed faith in us. Also, we had a very good technical partner with us, and hence the lenders were assured that whatever costs are being incurred, they are being incurred in the right manner, and they are being put to a very productive use. So we approached the lenders again after a 5 month period, and requested for another 100 crores of interim finance. And a major issue we faced then was that our limits were overdrawn, because the any cost that we had anticipated earlier, or the losses that we had anticipated earlier, they had gone up. And for a lender to sanction a facility when the existing facilities are overdrawn is a challenge. So we had to work towards resolution of the, or bringing back the limits within the acceptable levels, utilization within acceptable levels, and then we were giving an additional sanction. So when we started as a resolution professional, I and my team, uh, we did not have technical expertise. Of course, we were not expected to have a technical expertise into how a boiler operates, or how a turbine operates, how the machinery operates. So these things we did not know. However, it was essential for us to understand it from a commercial perspective, understand the unit economics, understand where are the linkages, where the coal comes from, what is the conversion, what is the cost per unit of coal, what is the cost at which I'm selling, where am I selling, are my receivables secured or reliable, or I would run into bad debts. So all these things we obtain an in-depth understanding through discussions with the employees and our technical partners. So this helped us identify the key pain points or the critical areas which we needed to address. We There were multiple issues, but we had to focus upon only a few points or a few key issues which would turn the needle.
Last time, whose computer did we use? Mine.
Sorry, I think guess somebody's.
Mine was not connecting there, no?
Then it's not your Harshita's.
Then let us use Harshita's.
But TV is not switching on.
Sir, can you please put your mic on mute, please?
Oh.
What we also did is we had to overhaul the entire organization structure which was there when we took over, especially the finance function, which was a kind of a weak link in the overall organization. We did not have a CFO. We did not have any of the KMPs, in fact. And we had to ensure that we get the right people into the company, either as a retainer or as an employee. And that was a major challenge. We saw at least three head of CFOs roll over in the 2 year period that we are running this entity. What we thought is appointing a cash flow monitoring agency would give a lot of comfort and would add an additional layer of checks into all the payments that are happening. So we appointed a reputed agency to verify all the payments. These were simultaneously also being verified by the RP and RP team. A major task was finalization of the accounts for the last 4 years. And we faced a challenge and obstacle where the directors were not willing. We had to resort to filing an application to NCLT. This went to NCLAT, and then NCLAT also upheld that the directors have to cooperate and sign the financials. So we were successful in getting an order, and since then we have finalized for 2 years, and the other 2 years is underway. So one of the key things is that you need a credible technical partner. The company did not have the right talent, because whatever talent was there, most of the people had left. So you were left with people who wouldn't find jobs outside. So there was a huge vacuum in that sense. Hence, we thought that it would be very essential to have a credible partner who would do the O&M, operations and maintenance, for the power plant. And we discussed this with the committee of creditors, and the committee of creditors was also very willing, and they understood the perspective that to have a credible O&M partner would add to the value and would also assure the resolution applicants that the unit, once it starts running, is being operated in a right manner. There are enough spares available, but the efficiency of the unit is good. So from that perspective, I think this is one of the key learnings that we got from this. Even if the cost initially, when you do not have funds, your focus is on cutting the cost. But even if the cost seems prohibitive, you should probably get in a good O&M partner who, or a good technical partner who can give an assurance or give you comfort as the RP, give the comfort to the COC and to the resolution applicants. This part I mentioned that we overhauled the entire organization structure, the policies, the matrix for approvals, filled in the KMP requirements. So all the vacancies we tried filling in. And we also appointed a factory occupier. As per the Factories Act, it is essential that the unit has a factory occupier who would be responsible for the unit. A resolution professional would find it very difficult to take over this onerous responsibility. So we appointed somebody who was based at the plant as the factory occupier with the approval of the committee of creditors. And wherever there were vacancies, we first tried to look internally if there were some deserving candidates who probably were not so much experienced in terms of the number of years, but however, they could do the job. we would elevate those employees and motivate them to take up additional responsibilities. Of course, the additional responsibilities came with additional pay for them, and we did not try to save our costs there. So what did we do for turning around the unit? From an operational perspective, it was very important. Three things were very important. One is that we needed to have an assured supply of coal on one hand. Second part was that we needed to have our PPAs in place, which are profitable. So what we did is we had a low profitability PPA, as I mentioned, because of a Supreme Court order. We were forced to supply uh, at a tariff which was almost half of the market rates, and we were making losses there. Or after we got the linkage coal, we were making some amount of profit, maybe 10-20 paise per unit we were able to make. A critical decision we had to take is whether to continue with this PPA. This PPA was for a 15-year period. Balance period was about 15-17 year. So that, and probably this was the only long-term PPA that this company had. So it was a very tough decision on whether we should continue with this PPA or we could look at terminating this PPA. So initially, when we took over, it was very critical for us to have a PPA because in a power plant, let's say a 300 megawatt power plant, you cannot, if I get a 20 megawatt worth of orders or power supply arrangement, I cannot operate the plant. There has to be a technical minimum, as they call it. So it has to run at, say, a 150 megawatt or 160 megawatt capacity in or that's so we needed this PPA to achieve the technical minimum. So initially, even if we were making losses or had bare minimum profits in this case, we took a decision that we would continue with this PPA. However, after a year or so, when the operation stabilized and the Discom, on the other hand, wanted even lower prices, that is where we took a very tough decision of terminating this PPA. We had to have several rounds of discussions internally, had to build a consensus with the stakeholders, with the COC members, and also because the resolution plan was approved by then. So we also have kept the successful resolution applicant informed on our decision, and they were also agreeable with the stand that we had taken, and hence we went ahead and terminated this long-term PPA. What it meant for us is that this freed up this capacity of about 100 megawatt, and when the market is very good, you are getting good prices in the exchanges also, or by entering into short-term contracts, we were able to generate more than double the amount that we would have made had we kept this PPA alive. Also, there was a continuous involvement of the RP and RP team along with the commercial team and NTPC for deciding on what PPAs to enter into. So, short-term PPAs, medium-term PPAs, long-term PPAs. Typically, you would want to avoid because CIP period normally about 330 days. That's the stipulated period. So whether you would take a decision of entering into a PPA and binding the incoming investor with this long-term contract, that becomes a very difficult decision. Uh, but you have to take a call on considering that an optimal mix kind of you'll have to have an optimal mix of short-term, long-term, and medium-term PPA in order to run your plant. And going concern remains the primary underlying in this case. So we entered into several short-term PPAs, which helped us increase our utilization. The utilization touched 56% in the last year, and the current year we expect to do about 75%. So this ensured that the capacity is being utilized efficiently, and hence the overheads are spread across the units. A major decision we took was to enter into a new PPA. It's a very rare case that a company which is under insolvency that participates in a tender, and then you win that bid to supply power to the discoms for a 5-year period. So initially we had discussions. We were not very convinced on whether we should go in for a 5-year PPA. However, given the litigation in the resolution process, whereby the time period for resolution was elongating, we had a relook at our strategy after 3 months, and then we decided to participate in this medium-term PPA of 5 years, which also gives us linkage coal. And this PPA has kind of added a lot of value in terms of the revenues, the profitability, and hence the overall valuation of the company. Sure. As I mentioned, linkage coal for the PPA where we had to supply at rates much lower than the market. Coal India had refused giving linkage coal to the company. This was before CRP initiation. When we came in, this was one of the critical things for us to address, because I couldn't be buying coal at 5,000 rupees, 6,000 rupees a ton and selling power at 3 rupees a unit. So if my cost of production is 4 rupees, I cannot sell at 3 rupees, because that becomes unsustainable in the short term also. So we had, as RP, we had this opportunity of interacting with the Ministry of Power, and we impressed upon them that without getting the linkage coal, probably we might have to shut down the unit. And it was essential for the CIRP, as well as it was very important for the country as a whole, that the power plant, all the power plants keep running, and SKS, which had its plant which was in a condition where which could operate, that would need a linkage coal. So with the support of the Ministry of Power and the Coal Ministry, we were able to get the linkage coal, and this was a big step in the turnaround of this company. Um, I mentioned regarding the capacities being tied up with a power trading company, and there was a lot of distrust, and they were not willing to negotiate. It was we had a couple of meetings with them. We negotiated tactfully, and then arrived at a common ground that the agreement be terminated without any payouts from either side. And it was so we arrived at a win-win situation where they were relieved of the requirement of having to get us short-term, medium-term, long-term contracts, and we also got a free hand where we could go to other trading companies. We could go directly to the discoms and enter into the PPAs. Maintaining the plant in a condition which has least number of breakdowns was very important, and to have the adequate levels of spares was also very critical. So along with the NTPC team, we worked out the requirement of spares. We had a limited budget, so we had to prioritize on what item to buy. There was a lead time in some of the spare items. So all those things had to be worked out. The plant had not undergone overhauling for a long period. There were two units at a time. We could take one unit under overhauling. That meant an expenditure of in excess of 20 crores. However, we took a decision that overhauling has to be done, which would improve the efficiency. Otherwise, the unit was seeing frequent breakdowns. So after the overhauling, the operational parameters of this unit improved significantly. The number of breakdowns also reduced. And now we are going ahead with overhauling the other unit also. Normally, you do the overhauling during the lean months of rainy season. This is being planned this year also. We have allocated massive budget for the overhauling exercise. A key thing in for a power company is, of course, are the underlying commercial contracts, and the company had a lot of litigations ongoing with the discoms, with even the banks, where bank guarantee was invoked, the money did not come in. Understanding the litigation was a very important thing, which we, along with our legal counsels, took great interest, and we put in a lot of interest, a lot of effort into that. Uh, because the stakes were very high. We had a litigation which had an impact of 70 crores, another litigation with impact of 100 crores, another one with 180 crores. So all these litigations put together had a value of in excess of 500 crores. So we had to ensure that we have top-notch litigation lawyers who would lead the company's cases in the courts. And we were successful in getting positive outcomes. In most of the cases, we have got a positive outcome. However, some of these cases have gone into appeals. But we expect a positive outcome at the apex level also. So with all this, what and this is the financial impact. Revenues of this company, 2021-22 is pre-CRP period. The company had done 570 crores. CRP first year of operations, we did about 516 crores. This was the period where the uh, plant was shut for the first 3.5, 4 months. And hence, also there were challenges in terms of the viability or operability of the plant because of the lack of spares. We were able to turn around the unit, achieve a break even in about 8 months of operations, and since then, we have been generating profits. So 2000 last financial year, we closed at the highest ever turnover for the company, about 1367. The current year target is 1800 crores, and now we are on the growth trajectory. EBITDA levels, which were negative in the pre-CRP period and also in the first year of CRP. In the second year of CRP, EBITDA levels are about 25%, and we are now at almost at par with the industry in terms of the capacity utilization, the operational parameters which are there in terms of the coal usage per unit or the auxiliary power consumption. Uh, and the overall profitability, we would do about 25-30% this year also. Last year, we did at about 350 crores of positive EBITDA, which has resulted in moving from a negative balance of 200 crores plus CRP cost of about 50. So From minus 250 crores, we currently are at a position where we have fixed deposits in the bank of about 350 crores. So you can say a 600 crore kind of movement has happened. Uh, PLF has increased to 56% in the last year. Current year, we are targeting about 75%. All India average of PLF is around 60-65%. What has that resulted in for the creditors? So as they say, the proof of pudding is in eating. After the financial turnaround which has happened, the lenders are seeing, the financial creditors are seeing 100% recovery of their principal plus interest. So one of the few cases which will see 100% recovery for financial creditors, this has been reported in the press also. Uh, and operational creditors would also recover a substantial portion. The initial bids that we got initially were at a level, and when we got the revised bids, because the unit was operating, we got almost double the value of that. It was a 1,000 crore kind of a jump which happened. I mentioned regarding the CRP costs and the interim finance from a negative of 250 crores. We are currently at about 350 crores of positive cash balance. And the operations are now self-sustaining. And we have laid down a plan for incurring the regular capex. We are not indulging in penny pinching. We are not splurging. However, we are ensuring that from a long-term perspective, the unit remains in a very good health, and hence all necessary capex, spare purchase, which is recommended by our technical partner, we are not cutting down on that, and we are incurring the productive costs. Some of the key learnings for us from handling this project, which we were able to successfully turn around. First question is, why is turnaround under CRP more difficult than turning around a unit outside of CRP? One of the major reasons that I feel is because you don't have a visibility on how long you are there for, when your strategy should be for a short term, medium term, long term. CRP maybe for 1 year, 2 years, 3 years, and it is like kind of like a moving ship. So taking decisions at different points in time and being very flexible in terms of the decisions that you take is very critical. Initially, we said no to terminating a PPA, but after 6 months, after 1 year, our strategy changed. Initially, we said no to bidding for a long-term PPA, medium-term PPA. After 6 months, we decided to go back and change our strategy. We decided to bid for that PPA. So what does not look good initially may seem very different after some points of time. So you have to be very flexible with your strategy. Contracts remain the underlying because they are the genesis of the cash flows which the company generates. Understanding the contracts, having flexible contracts, not tying yourself down to some contracts which limit your ability to, or doesn't give you flexibility, that would sound the death knell for any company. So under CRP, while you are obligated to honor the past contracts also, maybe you would want to relook at some of these contracts, renegotiate the contracts if they are not feasible or they are not commercially viable for the company. There would be any CRP company would have, say, 100 things where you might want to make changes. And it is often very tempting to try to address all these issues, but you have limited bandwidth, and you don't have the technical expertise also. You have to depend upon people for that. So you should focus. What we learned is that we should focus our energies on only critical things which would actually move the needle. So the classic principle of 80-20 is what we adopted, and wherever we saw that there would be high impact, we would focus our energies on that. Whatever could be tolerated or was within the acceptable levels, we wouldn't want to go in there and fix those things. Also, initially, as I mentioned, need to have flexible strategies also in terms of the way you operate. So earlier we started with a kind of a control and command approach. Then we went into as the unit stabilized. Initially, there was a lot of firefighting where the key focus was survival. After survival, we went into consolidation. Now we are into growth phase. So when you're into consolidation and growth phase, it became important for us to move away from this control and command model and then be an enabler. So the role of RP as an interim CEO, we have shifted from being an enabler in chief kind of a person. Working along with stakeholders is very important. COC is the key stakeholder, and all decisions should be taken in consensus with the COC. You may not see eye to eye on some aspects. However, it is the responsibility of the RP to provide all the underlying data and the rationale for whatever decisions you want COC to agree upon. Other than that, working with the employees is also very critical. Under CRP, we are tempted to tell them that companies under CRP, I will not be able to give any increments this year. First year, our increments were delayed, but we were looking at stabilizing the unit, and there was mass attrition. Hence, unless we operated in line with the industry, gave increments, bonuses, promotions in line with the industry, we wouldn't attract the right talent. We wouldn't be able to get people to stay with us or get people to join us. So we consciously went in for increments which were probably a little bit even more than the average, and build confidence among the employees. Even when we were incurring losses in the first 6 months, we ensured that the salary payouts happened in a timely manner. Dealing with vendors for your spares or critical equipment for the pre-CIP dues was a challenge. However, so we had an equipment where there was an OEM, we needed their support to commission that equipment. They wanted us to pay the pre-CRP dues. The dues were not very significant. We could have probably taken a decision of paying them off, but we did not. We were very conscious of the fact that if we do that, it will open up a Pandora's box. There would be overall we had 600 crores of dues to operational creditors. We did not want to set a wrong precedent. So that meant that we had to sacrifice our profitability in the short run. However, we managed to get other companies to work for us and complete the commissioning of that equipment. So these are some of the key learnings which we gathered over the last 2 years, and we were very fortunate that we had the support of the regulatory bodies, the Ministry of Power and the Committee of Creditors. And this is a classic case where interim finance can be put to good use, and the operations can be turned around, and the lenders can see the realization double or can go up even more if the unit is operating. A shut unit has maybe half the value as an operating unit. So this is all from my side. I would now request Ravin to take over and share his perspective on the legal aspects or the key points which should be looked at when you are handling a CRP of a power company.
Thank you, Ashish. That was quite insightful. In fact, few of the things that you mentioned was something that even I felt was quite helpful. And before I start, again, I would like to thank ICSI for inviting us and allowing myself and Trilegal to provide this presentation. As few of you may have seen the flyer, I don't quite look like Ramakant Rai because I'm not Ramakant Rai. I'm stepping in on his behalf. I'm Ravin Kapoor and I'm a counsel at Trilegal. And as my introduction was given earlier, I've had a chance of an exposure of working on multiple power project related insolvency resolution processes, wherein we have gained interesting experiences, which I'll be happy to share with the participants in this workshop. Uh, More so, our endeavor in this workshop is to also highlight our practical challenges that we face from a legal standpoint, and we can share our learnings from that aspect. And I'll be happy to also, take up any queries or questions which the members may have during the course of the presentation. So we can begin with that. I'll also ask my colleague to just change to the next slide. And just before I start, this is the so-called lay of the land that we have before us, where broadly we have segregated the presentation today on these five aspects. The first of them being relating to the classification of CIRP costs, because that is one element that we feel that specific to power projects, considering how these project documentation is done, could be something that we can shed our light on. Second is on debt servicing during CIRP and the permissibility around it. Third, it inter se priority of secured creditors. That sometimes these project financing is undertaken in various phases, and inter se disputes and challenges arise between the creditors who form part of the committee of creditors. So we'll be touching that in the third segment of our presentation. In the fourth segment, we'll be dealing on section 29A, which is the section relating to eligibility of resolution applicants. And in the fifth segment, we again would like to highlight some judicial pronouncements which are unique to power projects and share our experiences in that regard. Of course, I appreciate that's the end of our presentation, and usually towards the end, attention is at a premium. But I would urge the participants to have patience to discuss that aspect, because that I believe could have sort of interesting insights for the members today. So I'll start with the first aspect that relates to the classification of CRP costs. So broadly, CRP cost is essentially the cost that is required to run the corporate debtor as a going concern. So as a legal philosophy, the aspect is that once the CRP starts, while there is certain protectionist measures that are around the corporate debtor, but for other things, the company runs as a going concern. And the economic background behind that is that one is able to derive far greater value for a company that is running as a going concern, as opposed to a company that is being sold on a piecemeal basis. Rather, I would take a cue from on what Mr. Rathi had finished his presentation on, that if you were to look at the company, how it was at the starting of the CRP process, where the plant was shut, where there was lack of financing, where there was a certain amount that was required to revive the company as a going concern. All of that which was done during the CRP phase. CRP permits us to sort of undertake that limited revival and allow the company to stand on its legs and become a viable asset that can be acquired during the process. So in order to understand that, certain costs, of course, are required to be paid to have that interim revival. And these costs typically are considered as CRP cost. Certain examples of CRP costs that we've shared in the slide relate to that any interim finance that has been raised and the cost associated for raising such interim finance would classify as CRP cost. Any fees that is to be paid to any person, such as, of course, the resolution professional, its advisors, such as a 29A consultant or legal advisor, or in some cases, an auditor also is there. For such advisors, such fees also forms part of the CRP costs. Any cost that is incurred by the resolution professional for running the business of the corporate as a going concern. Now, this category could be, for instance, if it's a running company, then salaries are to be paid to employees. Certain operating costs needs to be incurred for purchasing raw material. It is possible certain capital expenditure perhaps may also be required to be undertaken. Rather, in this instance, I can give an example that there were recent NGT judgments which required that there should be a certain manner of expenditure be undertaken for disposal of fuel gas which is disposed during the power production stage, and that required the production of certain ditches, capital expenditure was required to be undertaken. So those sort of things will all fall under CRP costs. Additionally, the fourth category is with respect to any expenses to the government to facilitate the insolvency resolution process. So this can be, for instance, there's a fee now that is provided under the CIRP regulations known as the IPE fee, which needs to be paid if the resolution amount is more than the liquidation value of the corporate debtor. So that is also part of CRP cost. So yeah, this aspect also sheds certain more light on what would be a CRP cost. In fact, I will direct the participants' attention on the last bullet point, because the ones above I broadly discussed any which ways. But the last one is quite critical, where it discusses that costs can also be classified as CRP cost if they are approved by the committee of creditors. So in this regard, this is some sort of a residuary provision which empowers the COC to exercise its discretion in accepting and approving certain costs to be CRP costs. Now, while this is a discretionary power, there has to be some commercial nexus between such costs and the going concern nature of the corporate debtor. So that is a pertinent aspect that needs to be considered. In fact, this is an oft litigated issue, and that is important, of course, to be considered. And as for the next slide, like we mentioned, we have to segregate as to what cost will be considered as CRP cost, and only those costs which are considered as CRP costs can have that classification. And why this is critical? Because CRP cost is a priority payment aspect, and typically, while other creditors may or may not get 100% payouts, CRP cost is typically paid out as 100%. So therefore, it is critical that the classification is done as in accordance with law, because it has serious commercial implications. And the last aspect, like I mentioned, the Regulation 31E specifically discusses that COC, costs that are approved by COC will be considered as CRP costs. We can move to the next slide, where there is an IBC circular which has further sort of provided certain specific exclusions as to what would not amount to be CRP costs. And like I said, this is an oft litigated aspect. So I'll just quickly take you through what each bullet point broadly entails. For instance, the first one speaks that any fee or other expense not directly related to the corporate insolvency resolution process. So in certain instances, certain payments or fees which are being paid by the corporate debtor or otherwise by the RP, which are not linked with the CIRP, will not amount to CRP cost. Now that in some instances can be in form of penalties or some sort of levies that one has to pay. A levy, if in nature of a tax, will of course be a CRP cost, but some sort of penalty on account of non-compliance will not be CRP cost. The second bullet point discusses any fee or other expense beyond the amount approved by COC where such approval is required. So the regulations provide that only those costs that are incurred by the RP or the IRP would be considered as CRP costs to the extent ratified by COC. So, for instance, by way of example, if for public announcement, 1 lakh rupees is ratified by COC and the actual expenditure is 1,50,000, then that excess amount will not classify as CRP cost, and one can argue that that is actually a non-compliance by the resolution professional in that instance. Moving on, there's another bullet point which says that fee or other expense incurred before the commencement of CRP or to be incurred after the completion of CIRP. This is an interesting point. So any expenses that are actually undertaken prior or to the commencement of CIRP will not be CRP cost. And an interesting example of this could be, for instance, there's a provident fund payment or a TDS deposit that should have been done prior, but to CIRP. But let's say typically the company that is undergoing CIRP does that towards the end of a quarter. However, it deducts TDS for its employees for each month. So while it is not deposited, so to say, one can argue, not paid to the relevant, tax authority or relevant provident fund authority, yet it is deducted from the employees. But though that payment is not made, and that expense should have actually incurred prior to the but it was not done so. So given that it's done afterwards, it would not be considered as a CRP cost. However, there are some judgments around that shed light that certain critical payments in some instances may be considered CRP costs, even though they have been incurred or they should have been incurred prior. Similarly, the second element of this bullet point discusses costs that are to be incurred after completion of the act. So CRP is deemed to be completed with NCLTR and something the resolution plan. But most resolution plans provide for some sort of a buffer period or some sort of, you can say, a bridge which between approval of the CRP and the resolution applicant coming into place. In fact, I just read a chat box message that requires me to speak a little louder. So I'll do that, and let me know if my voice is not loud enough. Then I can maybe use certain other devices which perhaps can help me. Maybe I should resort to this only. Just give me a moment. Yeah, do let me know if this is better, and I'll of course try and speak a little loudly. But just on the point that I was discussing, that there is an interim period after approval of the resolution plan and before the new resolution applicant steps in. Typically, we call it as an interim period or a monitoring period, where for about a period of 3 to 6 months, a monitoring committee typically undertakes an interim management job. So those costs that are typically incurred by the monitoring committee or during that monitoring period is not part of CRP cost and is usually negotiated between the incoming resolution applicant and the committee of creditors, that how would costs during that time be undertaken. Then the fourth bullet point is on expenses incurred by creditors, claimants, or resolution applicant or promoter, or the member of the board of directors of the CD in relation to CIRP. Now, these expenses can be of the nature, like, for example, if someone is filing a proof of claim, and for that proof of claim, it has to undertake certain costs and expenses for stamping of certain documents, or for, procuring certain affidavits, or for, procuring documents or notarial acts, things like that. So those are not part of CRP costs. The fifth bullet point is penalty imposed on CD for non-compliance. This is similar to the first bullet point I mentioned, that if there is any penalty or fee on account of any non-compliance with applicable law, then this would also not be forming part of CRP costs. Any expense incurred by any member of COC, including on travel or stay or a professional engaged by the COC. Now, this is important. So in certain matters, particularly where the asset side is quite heavy, which is usually the case with power project CIRP, COC also has its own legal counsels, and fees for those legal counsels are not part of CIRP costs. Again, this distinction is critical because there were a line of cases in this regard, and like I mentioned earlier, that while COC has a discretion to approve certain costs to be CIRP costs, that discretion has to be exercised in a manner that it has to have a nexus with the going concern nature of the corporate debtor, and any legal counsel, any auditor, or any professional advisor or consultant that is appointed by the COC is a cost that the COC has to incur by itself and does not form part of the corporate debtor CIRP costs. Lastly, of course, any expenses that are incurred by the COC directly, that is also not part of CIRP costs. So we can go to the next slide, where we have broadly given a broad overview as to what is the test to be undertaken to classify whether a certain expense can be classified as CIRP cost or not. And
three aspects that you can see there says that such costs must be incurred by the RP or the IRP during the CRP period. So, like we discussed earlier, that any cost prior or post the CRP period will not form part of CRP costs, even though in that instance there could be a nexus to the corporate data. But because it is beyond the CRP period, it is not CRP costs. Then such costs must be incurred by the RP or IRP to keep the corporate data as a going concern. Like I mentioned, the nexus of undertaking such expenditure or incurring such costs needs to be with the going concern nature of the corporate debtor. And thirdly, then any expenses which are directly in relation to CIRP and approved by the committee of creditors. So in this regard, we've also broadly highlighted some instances where whether these costs were considered CIRP costs or not. For instance, like I mentioned, a penalty that is payable under a PP or any other agreement during CRP, if it does not inherently contribute to the objectives of the insolvency resolution process, or is not for maintaining the business of the corporate as a going concern, then the same shall not be classified as a CRP cost. So again, if there is a penalty that is levied, or if there is any cost that is to be incurred, which is not having nexus with the going concern nature, then that cost is not CRP cost. Again, in the case law that you mentioned, Sunil High Tech case, that was in fact passed recently by the Honorable NCLT last month, where they have upheld the test that classification of CRP cost and also observed that COC's decision regarding determination of a CRP cost falls within COC's exclusive domain and is not within the purview of tribunal's review. So, like I mentioned, COC also has exclusive powers in its commercial wisdom to classify certain costs as a CRP cost. So that was broadly about the CRP cost, and unless of course there are any queries or questions with respect to that, we can move to debt servicing during CRP. And before I move,
Ravin, I'll just interrupt for a bit. So
sure.
there's a practical challenge that we also face. It's an ongoing matter where because the plant did not operate initially in the CRP period, after 3 months we were able to restart the plant. An ongoing PPA for an ongoing PPA, since we had an obligation to supply power, we couldn't supply for the first 3 months. There was a penalty levied upon us as a compensation charges, and we have taken the stand that this is not essential. While this judgment has come in later on, we kept maintaining our stance that this is not essential for the going concern of the entity. This has not been approved by the committee of creditors, hence we cannot classify this as a CRP cost. And I think our stance has been now it's been upheld by this judgment. So
Yes,
this is a
that's
practical problem which
definitely helpful,
the
and
power
yeah.
companies face typically when they are not able to supply under their contract. But having said that, if I enter into a PPA now, today, during CRP period, probably I will not be able to take the same stance that if I'm not supplying for a month or so, I cannot say that this is not essential and I cannot, hence this will not be a CRP cost. Because when you are entering into the contract, a new contract, at that time only you have seen all the clauses, and hence it is presumed that all the costs under the contract will be CRP cost.
Yes, Ashish. In fact, that's a good example that you've highlighted. Rather, I would say that if you enter into a PPA agreement or any material agreement during the CRP period, it is also quite possible that the counterparty is mindful of these aspects and specifically has clauses inbuilt where it gives indication that this is specific for the going concern nature. Rather, in fact, that also I would like to also highlight certain other instances, like you mentioned. Like I touched upon the EPF matter, but I was also seized with an issue where the income tax authorities, based on certain prior, income tax related entries which were undertaken, had sort of increased the income of the corporate debtor and levied tax on that. And an argument that was taken and in fact was in fact approved by the NCLT in that instance is that while the order seeking additional income tax came in subsequently, and it is of course not CRP cost because it is not linked with the current ongoing nature of the corporate debtor, but given that it is pertaining to the financial year or the assessment year prior to the CRP, it can actually also be construed in the nature of of a due that is existent prior to the insolvency commencement date. So this aspect was also considered in that regard. And see, this is an interesting bit, and that's where I think these discussions and examples are helpful, because IBC, while it has been there for the last 7 odd years, it continues to be an evolving area of law, and on account of different subject matter specific issues, there are certain concessions. I mean, from the top of my head, I can give examples of power companies, of course, that we are discussing, and there can be unique issues, and few of them we are going to be discussing towards the end of the section. I can also give examples of, for instance, the aviation sector, wherein recently we saw a lot of aviation companies going under CIRP, but the way the aviation sector is structured, it's a very asset light entity, and most of the aircrafts are leased. So certain concessions were given for such international lessors of aircraft, and that amendment came through subsequently. We all are familiar with amendments which came subsequently, specifically for home buyers, because the way the real estate sector is structured. So one, as insolvency professionals, Ashish in his presentation also alluded to subject matter expertise. But the interesting bit is that it continues to evolve, and we need to continuously be updated of how these objectives of the IBC are aligned with that subject matter of the field. Like, for example, the real estate matter that I discussed, or the aviation sector, or the power production sector. Like Ashish very rightly mentioned, that a revival time can be considered in a certain manner, that even if that happens post CARP, but may not be part of the going concern nature, and therefore cost incurred due to not supply of electricity during that time may not be considered as CRP cost as well. So yeah, that definitely gives another dimension, that how the law is also evolving, and it may apply differently to different fields. I'll move on unless there are any other questions or discussions on the CRP cost, but of course happy to jump back to it if someone has any queries subsequently as well. So yeah, can we just move on to the next slide, which is pertaining to debt servicing during the CRP. So why we feel that this is also an interesting element and somewhat unique to the power sector, because project financing documents typically have a trust and retention account related structure, where all payments sort of go through from the TRA account. Now, when the company is not undergoing CARP, typically the TRA's control is with the lenders. So the lender's agent will have control over the TRA account, and to a significant degree influence the payments that are made by the relevant project SPV if the payments or debt servicing is not been undertaken during that time. The agreements are also in fact drafted in the same fashion. However, once the CARP kicks in, the agreement and the terms of the agreement are deemed to be subservient to the objectives of the code and the moratorium that is imposed. And the moratorium, amongst other things, does not permit the corporate debtor to make any payments during the tenure of the CRP, because such payment to one or two lenders or certain group of lenders who, let's say, have control over the TRA account will be classified as preferential payment. So, in fact, before I come to the preferential payment aspect, as perhaps already the insolvency professionals here would know, that under IBC, the payment mechanism has a certain distribution waterfall. So there is some sort of a queue that you need to follow while making these payments. And making any preferential payment is construed in various judicial pronouncements to be jumping that queue, and that is not permissible during a CRP period. So even though there may be TRA accounts and there may be instructions to the banks in respect to such TRA accounts or contractual constructs around such TRA agreement, those are all deemed subservient to the moratorium clause, and there is no payment that is permissible during the period of CRP. And courts have in fact consistently taken a view that the corporate debtor cannot be asked to part away with any money during the period of moratorium. So just to also take you through an example in this regard, for instance, not specifically to power companies, but the Supreme Court has in fact laid down that law in the case of Chitra Sharma and Union of India, where certain home buyers had sought directions from the court to disburse the amount that was deposited in court by Jayaprakash Associates Limited, that is the JP Infratex holding company, wherein a certain amount was on Supreme Court's direction was deposited as their welfare fund. But still that disbursement was not allowed by the Supreme Court, where the Supreme Court had in fact noted that as a matter of law, such disbursement will be impermissible since it will amount to preferential payment made to a particular class of financial creditors, whether secured or unsecured. Court also opined that the purpose of the process envisaged in the IBC for evaluation approval of the resolution plan is to form a composite approach to deal with the financial situation of the corporate debtor. I'll just pause here because I would again like to underscore that the composite approach aspect is pertinent for CRP related issues, and it is important that financial creditors, operational creditors, secured or unsecured creditors need to be collectively dealt by the corporate debtor. It cannot be done in a piecemeal manner. However, there is an interesting development in this regard, specific to again real estate projects, where real estate related companies can have CRPs specific to projects and not as a company as a whole. So, for instance, if one of the projects is not able to sort of make payments and there is default, then a project specific CRP can also be undertaken. Anyways, moving on to this aspect that we were discussing, that Supreme Court specifically denied any payments being made during the tenure of the CRP to any specific class of creditors. And this judgment, while came under the powers of Article 142 of the Constitution that allows Supreme Court to exercise extraordinary powers, but this judgment, in fact, has been oft-cited in other matters as well, including the power project-related matters, where any payment during the tenure of the CRP has been deemed to be impermissible. So that was with respect to payments during the tenure of CRP. We can move on the inter se priority of creditors. In fact, that cues well with the aspect that I was highlighting earlier with respect to composite treatment. So just a little background on how typically power projects are financed, which has a significant influence and bearing on this issue that we are highlighting here. So a power project is typically financed as different phases. Each phase may have 1 or 2 units, which are unique to that phase. And the commercial assessment undertaken by relevant lenders is undertaken phase-wise. So while there can be one company, but the assessment or the commercial evaluation done at the time of financing, it is done phase-wise. So a good example, in fact, would be one of the matters that we're dealing, and in fact, that is also being litigated in connection with this issue. It relates to Lanco Amarkanta Power Limited, wherein Lanco has 3 phases, of which one is operational, having 2 units of 300 megawatt each, and then there is one partly constructed phase, which again has 2 units of approximately 620 megawatt each, and then there is a third unit also that is yet to be constructed. So while the phase 1 lenders were different from phase 2 lenders, and there were certain common lenders as well, phase 1 was itself not a sick entity, not a sick unit. It was in fact a cash flow positive unit, and phase 2 was actually not completely constructed on account of commencement of insolvency of Lanco's EPC contractor. So what happened was that there was an interstate dispute between lenders, wherein lenders, which were phase 1 lenders, were of the view that they should have a superior security interest on Lanco's cash flows, because the cash flows are generated on account of the phase that they funded, and they are only solely phase 1 lenders. Whereas phase 2 lenders and other common lenders were taking a view that the CRP is of the corporate data as a whole and is not specific to phase aspects. So this was the background, and in this background, let me just quickly go through the various bullet points on the screen. So like I mentioned, construction and commissioning of various power projects are undertaken in phases or parts, and usually each part has a separate lender with distinct securities. I'll just pause here. So distinct security is also an interesting element. Like I mentioned, cash flow generated from phase 1 is typically secured in favor of phase 1 lenders and not for all the lenders of the corporate debtor. And these lenders usually have first ranking charge on phase one assets. In this instance, the asset that is currently operational and therefore, of course, fetches a higher liquidation value. Whereas phase two lenders or common lenders are given second priority charge with respect to these assets. So I'll continue. Consequently, the lenders and creditors for one of the phases may not be a lender for another phase. Now, CRP commencements for the entirety of the project, irrespective of its different phases, whether commissioned or not. So crucial when one of the phases is operational and profitable. Yes. Moving on. Now, the issue usually arises is that whether there should be any demarcation inter se ranking amongst the secured creditors having different security interests of the corporate debtor for the purposes of distribution of resolution proceeds basis the charge ranking and value of the security interest. So again, I'll pause here and just give you some background as to why this dispute typically even arises. So the power to undertake distribution of recovered amount under the CRP is vested in the hands of the Committee of Creditors. Committee of Creditors exercises decision based on their respective voting percentages. Now, these voting percentages is essentially the amount of claim that is admitted over against the overall claim of the corporate debtor. Now, again, when you submit a claim, it is not typically linked to the phase, it is linked with the corporate debtor as a whole. So there can be instances where I am, let's say, for instance, a phase two lender, but my lending was of a significant amount. Therefore, I may have a superior percentage value in the Committee of Creditors. However, my underlying security may not have the same liquidation value because I'm a phase two lender and phase two does not have the same amount of value like phase one. So what usually happens is that on account of me having greater percentage in the Committee of Creditors, I can influence the distribution mechanism that I intend to undertake, and that has been issue of dispute between these creditors because we'll discuss that the lenders who are, let's say, phase one lenders typically argue a certain line of aspects, and then phase two lenders also argue in their aspects. So in fact, we can move on to that aspect. Yeah, this slide of course deals with the issue which I broadly touched upon, and for the benefit of the members, I'll just highlight section 34 of the IBC, where if you see the second bullet point on the first column from the left, which says that the manner of distribution proposed, which may take into account the order of priority among creditors as laid down in section 53(1), including the priority and value of the security interest of the secured creditor. So two elements here are relevant. First is that while you are undertaking the distribution mechanism decision, you may take into account the order of priority amongst creditors and the value and priority of security. So members of the workshop will recollect that I highlighted that typically phase one lenders sometimes have a priority charge, or sometimes the value of their security interest being an operational unit has significantly higher value than the value of any other security interest of another phase which is not operational. So what usually happens is that they argue that this may term should be read as shall, and may does not confer discretion. Whereas typically the argument on behalf of the lenders who are either common lenders for both phase one and phase two, or only phase two lenders, argue that since the legislature has mentioned the word may, it should be read as may only and should not be read as shall. So whether COC, while exercising this commercial discretion while undertaking distribution, has discretion with the term may or is required to mandatorily follow, that in fact is still up for debate. And the way the judgments have progressed, this issue has been sort of referred to a larger Supreme Court bench to consider. So moving on. Yeah, this is the question with respect to waterfall mechanism under section 53(1), where it is highlighted that how these payments once received is to be distributed. So first is for the CRP cost and liquidation cost, like I mentioned earlier. Second is with respect to certain workman dues specific for 24 months preceding the liquidation commencement date. Then it's for some certain employee wages which are unpaid dues for the 12 months preceding the liquidation date. and then its financial debts owed to unsecured creditors. Of course, I didn't mention this, but in section B, if you see, workmen dues are equally placed as secured creditors who have relinquished the security, which shall run equally amongst each other. So this aspect, I'll just pause it again. So secured financial creditors are all equally placed. Now, it is within this category that the COC needs to consider the value and priority of security. So now everyone can be a secured creditor, but what is the value of that security is an essential component to be considered. To give you an example, certain creditors can only, let's say, have pledge over the shares of the corporate debtor. So they are secured creditors in the terms of the word that they have a security, but you will appreciate that the value of equity for an insolvent company is actually almost zero. So having pledge over equity shares while may make you a secured creditor, but your underlying value is absolutely nothing. Therefore, that element needs to be considered and applied while COC is undertaking distribution of proceeds. So this is, of course, the waterfall mechanism, but I'll just move on to discuss the contentions that is typically taken while an inter-se creditor issue arises. So I'll just go through these bullet points and elaborate and give additional context as and when required. So, for instance, it's provided that the mere initiation of CRP cannot completely override the differential bargains made by the creditors inter se and with the corporate debtor prior to providing finance or permitting security creation in favor of new lenders. So with respect to this first bullet point, I briefly touched earlier that because typically in power companies, the financing happens phase-wise and is not always linked with the company itself. The bargains that are struck during the financing of a particular phase are different from financing of another phase. So therefore, it is argued by those lenders, let's say, who have a superior right on an operating phase of a power company, that you cannot do away with those differential bargains. You cannot do away with, security that was created at that time just because CRP has commenced. So that is one of the critical arguments that they take. Then moving on to the next bullet point, priorities of claims established prior to insolvency proceedings under commercial or other applicable laws should be upheld in insolvency proceedings. So this is again the same line of argument that they take. Then differential bargains amongst creditors are negotiated to provide for clear mutual rights and status in a situation of insolvency. So again, I'll pause here. This is an example, like I mentioned, that if there are two phases and there are a bunch of, there is a consortium lending, then typically phase one lenders have first ranking charge on phase one asset and second ranking charge on phase two assets. And phase two lenders will have the same in the reverse, where they will have first ranking charge on the phase two assets and second ranking charge on phase two assets. So this is how mutual rights has been distributed at a joint lenders forum between different lenders in a consortium lending situation, which is again very common for power companies. So it is typically argued by those entities that differential bargains were struck prior to insolvency, and those differential bargains and mutual rights inter se the creditors should not be completely done away with because we have commenced with CRP. Moving on, if inter se priority is not given due consideration and all secured creditors are made to rank equally for the purposes of distribution under Section 53 of the IBC, then practically no secured creditor would ever choose to relinquish security in the liquidation estate. So essentially, the argument again in this regard is that if we reach a liquidation stage, then no one will want to relinquish the security within the liquidation estate, and liquidation process would definitely fail, and everyone will hold on to their own security if the inter se priority is not given due consideration. Moving on, distribution mechanism should be in compliance with 30 subsection 4. Amendment to 30 subsection 4 came into effect on August 2019, which has given a discretion to the COC to take into account the order of priority amongst creditors as laid down in section 53(1), including the priority and value of the security interest and secured creditor. The word may used in the provision is urged to be treated as mandatory by contending that the word may shall not always be construed as a giving discretion. So this is, like I mentioned, is a critical element. The argument is that may in this regard should be construed as shall, and that discretion that seems to come from the term may should be done away with. In fact, let me just walk back a little bit on the history as to when this amendment came through. So certain members on the workshop will remember that NCLAT in the SR Steel Clay case, which was one of the earlier cases resolved under insolvency, uh, had at that stage, NCLAT stage, permitted secured and unsecured creditors to be equally placed, thereby permitting even unsecured creditors who, again, like, prior to insolvency, had a completely different commercial structure, because as you would know, unsecured loans are given at a higher rate of interest because there is no security, and whereas secured creditors are at much lower rate of interest because there is security, and of course there is differential commercial analysis and commercial views taken at the time of providing such loans, had allowed them to be placed equally. And in order to rectify that position, while Supreme Court had reversed that order, even the law under Section 30, subsection 4 was amended, and thereby this aspect of considering the priority and value of security interest was introduced under the distribution mechanism. However, this introduction was, like the current position is suffixed with the word may, and the question whether the may aspect is discretionary or is to be read as shall is yet up for debate. But before we deal with that aspect, I'll just also highlight as to what are the contentions that are typically taken by entities who are in favor of reading may as may and retaining discretion. So we can move to the next slide. So they typically say that a demarcated distribution mechanism for each phase is not in compliance with IBC. They argue that since the corporate debtor as a whole is undergoing corporate insolvency resolution process, and it's not that different units of corporate and debtor are being put up for CIRP. Different units cannot be taken for deciding the claims of creditors since the incorporation is the CD as one entity and not for each phase. So the IBC framework currently does not, insofar as power companies are concerned, consider phase-wise insolvency resolution. It considers resolution for corporate debtor as a whole. They also argue the determination of a distribution mechanism for proceeds of a resolution plan falls within the commercial wisdom of COC, and such cannot be challenged by dissenting financial creditors. So in this regard, like I mentioned earlier, because of higher voting percentages in some instances, people who are having that higher percentage can influence the commercial decision making of the corporate debtor. And therefore, if there is an interstate dispute and it is pertaining to something, like distribution of proceeds, it is typically the lenders who have superior voting percentage whose decision, of course, will prevail. But whether the other lenders will get any sort of legal protection in this regard, that needs to be considered, because, like I said, that issue is currently referred to a larger Supreme Court bench, and the matter is sub judice. But this is one of the issues that is currently quite alive in the insolvency phase. But anyway, I'll move on the next bullet point, where distribution mechanism should be in compliance with 30 subsection 4. Supreme Court in the SR Steel case and the India Resurgent case have held that discretion is given to the committee of creditors under subsection 4 of section 30. And the word may makes it clear that this is only a guideline which is set out by the subsection, which may be applied by COC in arriving at a business decision as to acceptance or rejection of a resolution plan. So again, like I mentioned, current legal position as held in this SR Steel case and India Resurgent case is clear that may is only a guideline. It vests discretion with the COC, and COC in its collective commercial wisdom can exercise that discretion either which way. But again, I'm reminding the members that both SR Steel case and India Resurgent case were considered by the case by DBS Bank Limited versus Ruchi Soya Industries by the Supreme Court. And Supreme Court, while considering these cases, has referred it to a larger bench because it was also of the view that perhaps this issue may require a reconsideration. So that matter is currently still pending. So moving on, the next bullet point highlights that financial proposal in a resolution plan forms the core of the business decision of the committee of creditors. And if all mandatory requirements have been duly complied with and taken care of, the process of judicial review cannot be stretched to carry out quantitative analysis qua a particular creditor or a stakeholder who may carry their own dissatisfaction. Lastly, in fact, this line is directly from the the India Resurgence case, where Supreme Court has held that in the new IBC, every dissatisfaction does not partake the character of a legal grievance and cannot be taken up as a ground of appeal. So that is the position of law as of now, but this aspect still continues to perhaps be litigated, and this may change depending on which way the Supreme Court sort of leans in the matter that is currently being referred. However, we have some views and observations that Supreme Court in the SR Steel has observed, wherein they've held that the ultimate decision of what to pay and how much to pay each class of creditors or subclass of creditors is with the COC. But the decision of the COC must reflect the fact that it has taken into account maximizing the value of the assets of the corporate debtor and the fact that it has adequately balanced the interest of all stakeholders, including operational creditors. Section 53 of IBC would be applicable only during liquidation and not at the stage of insolvency. It was also upheld that Section 30, Subsection 2B of the code refers to Section 53 not in context of priority of payment of creditors, but only to provide for minimum payment to operational creditors. It further held that this does not in any manner limit the committee of creditors from classifying creditors as financial or operational and or secure or unsecured. I'll just pause here again, just to give additional context that Supreme Court has time and again, and of course we are dealing with SR Steel case examples here because that was one of the first cases, but this is in fact oft repeated by Supreme Court that committee of creditors has commercial wisdom, and commercial wisdom when they exercise while assessing what is the best way of value maximization and what is the best way of distribution of proceeds intersect creditors. Such commercial wisdom is not justiciable before courts of law. So in fact, in this regard, Supreme Court acknowledges that bankers and financial professionals have requisite and one can argue superior commercial understanding of how things would play out, and they do not want legal experts to enter into the field of doing quantitative analysis of how the commercial wisdom exercised or not. However, all that it has done, that currently the statutory provision is limited to this aspect, that a limited amount of liquidation value due to certain creditors, now that can be operational creditors or dissenting financial creditors, should be provided. Now, while assessing what will be the liquidation value to such creditors, we look at 53, but 53 is specific to liquidation process. So at the insolvency stage, 53 is only a guidance. It is only a deeming provision that you will have to see what would be the liquidation value due to such creditors and whether that limited liquidation value is being paid or not. Again, in this instance, I can give you a practical example. In some instances, during the CARP, the value of the corporator can increase. Like Ashish was also mentioning in his presentation, that on account of certain efforts, on account of proper interim financing, on account of because moratorium does not allow you to make interest payments, then because certain amount may balloon into the fixed deposits and other deposits of the corporate debtor, the value of liquidation which is assessed at the insolvency commencement date may be perhaps lesser in some instances than what it is at the time of distribution. Now, in this regard, it is also, in fact, up for debate that do you do a re-evaluation or do you do a notional evaluation as to what is to be paid to such dissenting financial creditors or operational creditors, and if at all, their liquidation value increases. While mostly for operational creditors, it is usually seen that if such operational creditors are unsecured, then it remains nil. But in some dissenting financial creditors issue, this can actually increase. So that analysis has to be undertaken at the distribution stage as well. Lastly, before moving on to the next point, the word may used in Section 30, Subsection 4 gives discretion to COC and is not a direction. Fault cannot be found with COC in case for deciding to distribute the assets in accordance with admitted claims. So like I mentioned, since 30 Section 4 uses the term may, it is not mandatory for COC in all aspects to consider the value and priority of security. In some cases, it can have a different mechanism, and that mechanism can be simple sitter as to distribution of claims by way of admitted claims and not giving much heed and regard to the value and priority of securities. So we'll move on where we briefly also discuss the India resurgence case, because the SRC case and India resurgence case currently hold the law and legal position on this matter. So a few aspects of the India resurgence case also I'll just explore quickly. Where it says that prior to amendment of section 30 subsection 4, the COC was not required to consider the value of security and interest, the value of security interest obtaining in favor of the secured creditor, while arriving at a decision in regard to feasibility and viability of a resolution plan. Legislature brought in the amendment to amplify the scope of the considerations which may be taken into consideration by COC while exercising the commercial wisdom in taking the business decision to approve or reject a resolution plan. Such consideration is only aimed at arming the COC with more teeth so as to take an informed decision in regard to viability and feasibility of resolution plan, fairness of distribution among similarly situated creditors being the bottom line. Such business decision taken in exercise of commercial wisdom of COC would not warrant a judicial intervention unless creditors belonging to a class being similarly situated are not given fair and equitable treatment. So I'll pause again here. I mean, in fact, this is broadly repetition of a few aspects that I mentioned earlier, that this is just an enabling provision so far. That's how it's been interpreted by the Supreme Court. It is to empower the COC with additional aspects that it may consider. Right now, it is not mandatory to consider. The bottom line being that similarly situated creditors should not be dealt unfairly. So, for instance, if the committee of creditors is of the view and in its commercial wisdom thinks that they want to distribute the recovery proceeds by way of admitted claims, then all similarly placed creditors should get the payment by way of admitted claims. No one should get a superior right. So the distribution methodology cannot give superior rights to similarly placed situated creditors. But however, if the requisite votes are cast by the members of COC, it has the power to decide the distribution mechanism. So yeah, I mean, subsequent points are also broadly repetition. So I'll just move on to the discussion that actually happened in the Ruchi Soya case, which differed from the India resurgence case and in fact referred the matter to a higher bench. So I'll just quickly go through these bullet points, where the court noted and agreed that the observation that voting in under section 30 subsection 4 is essentially a matter which relates to commercial wisdom of COC, and that a dissenting secured creditor cannot suggest that a higher amount be paid to it. However, this does not affect the right of a dissenting secured creditor to get payment equal to the value of the security interest in terms of section 30, section 2B2 of the IBC. It is also correct that the legislature has not stipulated that the dissenting financial creditor shall be entitled to enforce the security interest. However, it is incorrect to state that the dissenting financial creditor would not be entitled to receive the liquidation value, the amount payable to him in terms of section 53(1) of the IBC. Dissenting financial creditors are entitled to payment not less than amount payable under section 53(1) in the event of liquidation of corporate debtor. On the approval of the resolution plan, the dissenting secured creditor must foresee the security and is entitled to its liquidation value. However, it is clarified that section 32 safeguards the dissenting financial creditor from settling for a lower amount than its entitlement under the liquidation. While it is important to maximize the value of assets of the corporate debtor and prevent liquidation, the rights of operational creditors or dissenting financial creditors also have to be protected and stipulated in law. Now, in light of a different view and ratio from India resurgence case on interpretation of various sections of the IBC, the question on position of dissenting financial creditors has been referred to a larger bench of the Honorable Supreme Court, and the matter is sub judice. So this is how essentially Ruchi Soya sort of differed with India resurgence, where it also was of the view that dissenting financial creditors also, their right needs to be protected, and because it's like India resurgence case was a division bench judgment, and Ruchi Soya case was also being heard by a division bench. The subsequent division bench could not have rendered a different decision from a prior division bench. However, it was leaning towards that. So in order to assess this issue accurately from a judicial standpoint, the court had referred the matter to the Chief Justice of India for sort of setting up a special bench, and a larger bench, of course, that is more than two judges, will be looking into this matter, and a final decision in this regard is awaited. So we can go to the next section. Of course, the issue that we discussed earlier was predominantly inter-se financial creditors who form part of the COC. But another important aspect that has come up, and again have particular relevance in case of power companies, is that in some instances even operational creditors can be considered as secured operational creditors. Now, what this security does in this regard is that the liquidation value to such operational creditors becomes more than nil. So, like I mentioned earlier, because the way the hierarchy is set out in the under section 53 of the IBC, operational creditors being pretty much in the lower rung of hierarchy, or unsecured creditors being the lower rung, they do not get a sufficient recovery, and in most cases it is nil or almost nil. However, if they become secured operational creditors, and for the purpose of section 53 they will become secured creditors, the underlying security that they have will give them certain liquidation value, and that is the reason why various statutory authorities, on account of certain statutory provisions of law, have agitated issues before courts, and I would say successfully so, got themselves identified as secured financial creditors. And this issue also continues to develop. In fact, two cases that we cited above have been passed in the last 2-3 months only, wherein on 12th of February, in the case of Greater Noida Industrial Development Authority versus Prabjeet Singh Soni, Supreme Court has recognized Greater Noida Development Authority as a secured operational creditor. Similarly, NCLAT in Yamuna Expressway Industrial Development Authority versus JP Infratex Monitoring Committee in May 2024 has identified Yamuna Expressway also as a secured operational creditor. So in both these cases, the underlying legislation had given them the requisite right to have security charge over their unpaid dues. Now, here again, I'll pause and try and chalk out an interesting distinction between two types of securities. One is known as a transactional security, that is a security created by way of a transaction. For instance, if I raise loan and I create a security on my assets and do requisite charge filing and execute mortgage deeds, etc., that creates a security by virtue of that transaction, known as transactional security. However, while not specifically recognized in IBC, but otherwise, of course, recognize that certain security can also be created by way of statute, where the underlying statute says that if dues of, let's say, a certain authority is not paid, then that authority will have security over the, requisite, let's say, land which it has leased to you, or there's a concession, so that land can be used for making payments to that authority. So that is a statutory security that is created, a statutory charge that is created. And these requisite authorities, since the rainbow paper judgment of the Supreme Court, has tried to identify themselves as secured operational creditors, and on account of them having that security, they have sort of tried to avail greater recovery under IBC. But it is also important to note that this element of security being transactional and being statutory was in fact noted in another Supreme Court judgment, and there are currently certain conflicting Supreme Court judgments on the question of law. So if you see the last bullet point, I'll just quickly read for the benefit of the members, that there are conflicting judgments of concurrent division benches of the Supreme Court on the question of whether a security can be created by operation of law, that is in State Tax Office versus Rainbow Papers Limited, and Paschimachal Vidyut Vitran Nigam versus Raman Ispat, which restricted Rainbow Papers to the facts of that case. So yeah, just we'll move to the next point. Then what is the impact of such classification? I of course briefly touched upon that the impact typically is that all these government dues will essentially become secured dues. And again, just to refresh the memories of the insolvency professionals here, the Bankruptcy Law Reforms Committee, which was the precursor to IBC, specifically wanted to not have government dues and crown debts to have superior rights over financial creditors. Therefore, 53, the distribution waterfall specifically brings them beneath the secured creditors and employment dues. But if you consider them as secured creditors, you essentially bring them back up. And that was expressly not advised by the Reforms Committee, which was a precursor to the IBC. So while interpreting provisional IBC, it is argued that such an interpretation will not be in the interest and objectives of the court, because in that regard, most of the payments will actually essentially go to government coffers, and relevant financial creditors will not have successful recovery, which was the objective of the court in the first place. So I'll quickly run through the bullet points that where we have touched upon that what could be the impact of such classification if we start considering even statutory security akin to transactional security. Categorization of Yamuna Expressway's dues as secured operational creditor made it at par with other secured financial creditors, leading to realization of higher percentage of claim. Consequently, NCLAT directed that successful resolution applicant to pay additional amounts to Yamuna Expressway in line with the ratio of amounts received by other secured creditors. The consequences of holding, Gujarat, my apologies, not Gujarat, holding Greater Noida Industrial Authority and Yamuna Expressway Industrial Authority as secured creditors may have adverse ramifications for approval of resolution plans, since the claim of these entities could be very high. An inclusion of such interest and penal charges over principal amount as secured creditors can really bring down the recovery amounts to financial creditors. Such classification may open a Pandora's box, given that all operational creditors who have a statutory charge may claim to be treated on par with other secured financial creditors. Secured operational creditors will be entitled to much higher minimum liquidation value threshold by virtue of security interest. And many other statutory authorities having similar provision may also accordingly be treated as secured creditors. Now, other authorities can be in the nature of, for instance, municipal authorities. So even municipal laws have underlying provisions where any municipal dues can be recovered as security. So that is one aspect which, from a professional standpoint, we feel will not be in line with the objectives of the court. And like we highlighted, in this regard also, there are some conflicting Supreme Court decisions, and the matter is yet to be finally settled. So with this, we can move to the next section of our presentation, where we have discussed section 29A relating to eligibility criteria for the resolution applicants. So this is also an often litigated issue, wherein certain resolution applicants who fall in any of the ineligibility criteria set out under section 29 of IBC are not permitted to be resolution applicants. So, of course, the section itself is quite verbose. So I'll just quickly touch upon few pertinent aspects. Like, for example, if the resolution applicant or any of its promoters, directors, or connected parties are undischarged, insolvent, or it's a willful defaulter, or at the time of submission of a resolution plan already has an account of a corporate debtor under his management, where such account has been classified as a non-performing assets in accordance with RBI guidelines or the guidelines of any financial sector regulator. That can be, like, for instance, if there are any sort of SEBI related, strictures or prohibitions passed against such an entity. If they are being convicted for any offense punishable with an imprisonment for 2 years or more, if they are disqualified to act as a director under Companies Act, if they are prohibited by Securities and Exchange Board of India from trading in securities or assessing securities market, or if the promoter or management or control of the corporate data in which a preferential transaction or undervalued or an extortionate transaction has been undertaken. So these are the few of the aspects that one needs to analyze to assess whether there is any 29A related ineligibility which is falling upon the corporate data. So we can move to the next part, where we've sort of highlighted that certain ineligibility aspects can in fact also be remedied. Not all, but certain can be remedied. Like for example, 29AC of IBC say that a person shall not be eligible to submit a resolution plan if such person or any person acting jointly or in concert with such person at the time of submission of the resolution plan has an account or an account of the corporate debtor under his management, where he is a promoter classified as an NPA and according to the RBI guidelines. And at least 1 year has lapsed from the date of such classification till date of commencement of CIRP. So in this regard, it is pertinent to note that there is a 1 year timeline aspect is given, because sometimes due to cash flow issues, certain defaults may happen, and that may trigger the guidelines, and banks and financial institutions may be required to classify it as an NPA. But otherwise, if not for the cash flows issues, they will not have had those aspects. So that period is given. In fact, that period is also given as a way for them to rectify this issue, and payments may be made prior to submission of the resolution plan, or maybe even after submission of resolution plan, but prior to sort of approval of plan, whereby the 29A ineligibility that is casted on them can be resolved and removed. So that is there. We can move on to the next slide also. These are the dates that in fact I just alluded to. So again, we can move on to from this aspect as well. There's an interesting Supreme Court decision in this regard. We can deal with that, which is on the next slide, where Swiss Ribbons, the court has sort of given some justification and background that why there is what is the legislative intent for such 29A aspect to be introduced. In fact, before I touch upon this aspect, the logical aspect or issue is that IBC should not be a mechanism for such promoters and managers who themselves have not, made payments to their for their assets to lenders, and then use IBC as a mechanism to avail a discounted price for the same asset. In fact, that is how SR Steel and its promoters were trying to reacquire SR Steel, because while they did not, they had undertaken defaults earlier, but during the IBC, they were of the keen view that they can make payments and reacquire the SR Steel asset. So in that case as well, Justice Rohinton Nariman has said that 29A is in fact a see-through provision, and one needs to actually see through that who is the real promoter or who is the real acquirer, and check whether any of the disqualifications fall upon such real acquirer or not. But yeah, we'll check on the Swiss Ribbons aspect as well, wherein I'll just quote from the relevant paragraph, where the court noted that a person who cannot service a debt for the aforesaid period is obviously a person who is healing itself. The saying of Jesus comes to mind, where they say that if the blind lead the blind, both shall fall into the ditch. The legislative policy, therefore, is that a person who is unable to service its own debt beyond the grace period referred to above is unfit to be eligible to become a resolution applicant. So this was the logic behind having this as a policy aspect, that someone who himself is a 29A disqualified entity should not be allowed to submit a resolution plan. So that was broadly the legal landscape. We thought that another aspect that we can quickly allude to is certain judicial pronouncements specific to the power projects, where the way the power project production chain operates, how courts have stepped in and have sort of aided corporate debtor in running as a going concern and protected its value. So, and in fact, as the schematic diagram sort of indicates, if you put the corporate debtor and the power producing entity in the center, technically it has two essential material contracts. One is of the fuel service agreements. That is, for instance, if it's a thermal power plant, then coal and requisite raw material. And the other is the power purchase agreements, where how these power that is once generated is to be sort of off-taken, and there it is requisite that a PPA is in place. So there have been judicial judgments in this regard. In fact, I'll start with the one relating to PPA agreements, where Supreme Court in the case of Gujarat Vikas Nigam Limited versus Amit Gupta observed that if the PPA is to be terminated, the corporate debtor would not remain as a going concern. Hence, the continuation of PPA is necessary for the effective completion of CRP, and termination will result in the CRP being inconsequential. So I'll just give some background here. So what happened in that case, that there was a special purpose vehicle, and the only economic activity that the company was undertaking was producing power, and the power was of course being off-taken through a PPA. Now, because of the ongoing insolvency, the PPA had what in legal parlance we say ipso facto clause, where just by the mere fact a certain consequence will befall upon the one of the counterparties to an agreement. So in that regard, there was an ipso facto clause relating to initiation of insolvency, where the contractual agreement said that if there is initiation of insolvency, then the PPA will stand terminated. So in this regard, the court sort of looked into this issue and said that ordinarily in an IBC situation, we will not have jurisdiction or to sort of change the terms of the contract, because terms of contract between two parties have a inter se privity, and third parties cannot come into the place and change the terms of contract, or circumstances cannot be found basis to change the terms of the contract. So ordinarily court said we would not have done that. But in this instance, this contract, this PPA is essentially the soul of the corporate debtor, and if you take away the PPA, there is no financial viability for a power producing company. So the court said that termination of therefore PPA just on account of the fact that the company is undergoing insolvency is not permissible, and they stepped in and protected the corporate debtor and did not permit termination of the PPA. The PPA was held to subsist and be alive, and in fact, as you can imagine, that was one of the major reasons for the value deriving value for the relevant entity. In fact, similar argument was also before NCLT Hyderabad, in fact, in one of our matters, where the fuel service agreement was terminated by Southeastern Coalfields, wherein they said that because of some past non-payments and because the corporate debtor actually not operating with respect to certain phases, we cannot provide requisite coal allocation, and they wanted to terminate the fuel service agreement, and they had issued a letter in this regard. In this aspect as well, the court noted that if you terminate the fuel service agreement, then the under construction power plant that is expected to be completed, the construction is expected to be completed by the resolution applicant, there will be no incentive for the incoming RA to complete the construction and revive the corporate debtor if it does not have a FSA in place. So in that regard as well, the termination of FSA was held to be illegal, and it was also reinstated. So in fact, these were two examples from our experience. We felt that which are very unique to power sector, but the objective and the legal sort of takeaway from this is that while in ordinary situations contractual aspects are to be complied with and they cannot be changed, however, in extraordinary situations where such a contract is of such significant materiality to the corporate debtor that the value and survivability of the corporate debtor is linked to such contracts, then such contracts, even though they may have termination provisions which can be triggered, are not permitted to be triggered on account of letting the corporate debtor have intrinsic value. So those were the few things that we felt we should discuss. And with that, we also come to the closure of at least my presentation. And unless there are any questions or concerns or anything that members may want to discuss, as they say in law firms and courts, I rest my case.
So you want to check if there are any questions, we can take those, or otherwise we can conclude the session.
I must compliment you both, Ashish and Ravin, for a very exhaustive and a complete presentation. And this is a very, very technical. IBC per se is a technical subject, and power sector in IBC is especially so. So I guess that most of us who are participating, we are only overawed and very impressed with your depth of knowledge. And one can see why you have succeeded, because both of you have worked very hard. I incidentally have got recently a power project in Maharashtra, which I am hoping to work on. So, I mean, it could be relevant for me to connect with the both of you. I will do so separately. But on behalf of the class, let me congratulate you, both of you, and say thank you very much.
Thanks, Kapil, for those kind words. Very encouraging. So, and yeah, we'll be happy to connect with you in future.
Thank you, Kapil ji, for the kind words, and we would be happy to share their insights. Recent power case that you are handling, would like to see that that is also very successful, has a very successful outcome.
Sure, will do.
Anjali, should we do you want to go ahead and close this session formally?
Right, sir. So thank you very much, sir. Thank you very much, Ravin, for taking out your valuable time and giving your thoughts and share your experience with all the participants. Thank you very much.
Thanks for having us.
Thank you. Thanks. Sir.